All right. Good morning, everybody. TGIF. Just a reminder, next Tuesday, there won't be a morning briefing. I'll be out of state. So we had some reasonably decent news last night with Netflix. Apple had some news in the overnight as well. So that's two of the FANG group, or Netflix doesn't really fit into the Mag 7, but definitely into the FANGs. But we're not seeing in the indexes what we would expect to see after at least two of those names get such a bump. If you look at the indexes, sure, the Nasdaq is up, about a 0.5%, but the S&P is not. It's at 0.25%. The Dow is basically flat. UK down 0.25. Japan put out some news. It does look like they're going to have issues on the inflation side of things. I had warned about keeping an eye on Japan. They had data coming in. If they get to messing around and raise rates, mess with that carry trade, oh boy, markets are going to feel that. We are seeing hedging activity in the pre-market. We got housing starts and building permits, and then we have 4 Fed speakers today. And while housing starts and building permits don't rank as high as, some of the things we would worry about, like CPI, PPI, non-farm payrolls, job numbers, there's hedging this morning showing that these are important. They're concerned about the numbers we're looking to get today. If you look at the consensus estimate, it's not looking that rough, like matching numbers. So where's the concern come in? The China group is up this morning. Bitcoin is up, precious metals, chips, airlines, even small caps. They're not quite up enough, but they're working in the right direction. And some of the Mag 7 group, and yet we're not seeing this sort of move we'd want to see, right? Where is everybody, right? Where's the exuberance, the animal spirits, whatever you want to call it? We don't see it. What we do have is hedging this morning. Now, I get it. If you don't have Thinkorswim, you don't have access to this market maker move. And if you had read the ticker tape publications on this or the Schwab website now on market maker move, they never mention futures at all. But what a market maker move is signaling is that the options in the front of the options chain have a higher implied volatility average than the next series out. So if we just scrunch everything up here so that we can see the numbers next to the expiration, today, the 0-day has an implied volatility average of 10.1, and the next expiration out has one at 8.93. When that front number is higher than the next number, you get a market maker move. It implies hedging activity. Now, hedging happens all the time in the future, so it's not like something new. It's not like they weren't hedged and now suddenly they are. This is additional hedging. The way that that number is calculated, it's proprietary for every broker. That's why if you go from TASI to Thinkorswim to Schwab, Fidelity, IBKR, they're all going to have a slightly different number. It won't match perfectly. And that's because there's a little bit of secret sauce that they won't share with us. But we know what some of the calculation is. It's using how much time we have, and it's using the implied volatility on the options chain itself. So every one of these options has an implied volatility value, and it's using the out of the money options on the call side, the out of the money options on the put side. It gets a calculation average of that with a square root of time, and it comes up with that number. When they're in here hedging and they hedge out of the money, do a lot of trading on these particular strikes, it jacks up the implied vol of those strikes, and we get a market maker move. That's how it happens, right? So when I say they're hedging this morning, this isn't my opinion. I'm not, hypothesizing and guessing and just telling you what I think. This is a fact. They are hedging this morning. They're concerned. They're worried about something, and they're hedging because of that worry and because of that concern. If we didn't have economic events today, if we looked at the calendar and there was just nothing there, at least this would tell us, watch out. Go look for a reason. Why are they so concerned that they're spending money on a hedge? Because it's just pure cost for them to run a hedge. Take money and light it on fire and throw it in the fireplace, right? That it's just cost. They won't spend that money unless they're feel that there's a need to spend it, to have that insurance. Now we can see the building permits, housing starts. That really doesn't rank very high on my list of economic events to be worried about. But now that we know that they are hedging, we can see that they're hedging. We have to be concerned about it too. Volume's not as light as I would expect seeing hedging, but this isn't really big numbers yet. If this grows twice as big as it is now, then I'd be more concerned. We're sitting at 55 on the overnight volume. Again, that's not as crazy low. If it was, say below 45, we'd be more concerned. But it is a little off. Even just yesterday, we had 83,000. 55 the day before, 62, 49. That was a pretty low day on Monday. So they're not exactly completely sitting out, but we are running on a slightly lower volume. They are hedging. They are concerned about these numbers. So we need to be concerned about these numbers. Because it's an 8:30 print, it could offer the opportunity for a gap close play, just like we've talked about before with the CPI, PPI, non-farm payrolls. At 8:30, we could get that really big candle. And no matter which direction it goes, just keep in mind, if it's a liquidity gap, it could be unwound. So say we get a big move to the upside, we get that really big candle, and then we spend the next 2.5 hours unwinding that big move, going right back to where we started at 8:30. So just kind of keep that in mind. Plus, as I mentioned, with Apple and its good news and Netflix and that good news and global markets up around the world, why are we only up 0.25% in the S&P? That's something to be worried about. I do have a halfback marked at 5,900. It's not just a halfback. It's a round number. Round numbers are important. It's an options level. It's a level of liquidity. It's an area to pay attention to, and it's what we're struggling against right now. Got the other halfback marked, which is from Tuesday. We've been using Tuesday's range Wednesday and Thursday, and we're using it yet again today because we're just not done with it yet. Since we are up 0.25%, if we can get through the 5,900 halfback, then we've got the ADR half at 59.11 cog line. Get through the liquidity zone and challenge yesterday's high. Try to get through that level up there. It's not the call wall. It's just one of those double gamma levels or triple gamma levels. A confluence. It's an options level. Got to get through all of that. 59.32 cog line, which would be a liquidity shoot above yesterday's level. And then we get the ADR full and the call wall. If you measure all of yesterday, you'll see that liquidity shoot that I was talking about right there. 59.32 cog line. That is the liquidity zone. But to even get there, we've still got to get through all of this from Monday afternoon and Globex Tuesday. I think just because we went through there once, I don't think we're done with that liquidity. But if we are, then we would just take this zone and bring it right up here, because that'll be the next spot. On the other hand, if it gets negative and we're heading to the downside, 58.91 cog line, get reciprocation on VWAP. I know that's a lot of big words early in the morning, but think about your jigsaw, right? You go out in the garage, fire up a reciprocating saw, a jigsaw. What you get in one direction, you get in the other direction of equal and important size. Reciprocation. That's a concept you can use in markets for all sorts of things, from RSI, MACD, stochastics, and also just measuring things like candles, ranges. So if we have this much range to the upside above VWAP, if and when we break to the other side, we're expected to at least make that much. Well, to do that, we got to first get through VWAP, then we got to get through the cog line 58.91, which is also an options level. The halfback at 82, ADR half at 61, volatility trigger, our own Globex low, yesterday's Globex low, and then 58.50 down here, which is around the 10-day moving average and the 3-week moving average, and a liquidity zone from Tuesday. We got a lot of structure on each side. That's if we get a big move in either direction. It's absolutely possible that we just stay inside of Thursday's range all day today and go into the close with a whimper, holding these moves that we've made this week. If you take a look at the week, it's not a bad looking week. You know, you consider where we've been in the last 5 weeks. That's the 5-bar rule. Keeping what we have now and going into the close, holding this zone, would be a really good week. And it would fit the narrative that they continue to press upon us out there. When you put it on a daily, it's pretty easy to see the candle in control, right? There's your boss. Got to get out of this before we're going to do anything else. And the base case argument for today is that we're not going to get out of this, let alone get out of yesterday's range. If you don't have Thinkorswim, you can still look for the market maker move. As long as you have the options chain, you can go in and compare those two expirations. The ADR continues to shrink. A month ago, it was close to 1.7%. Now it's 0.9. So it's a pretty small average daily range. And the lower it gets, the more it's a representation of lowered volatility. It is worth noting that our ADR levels, at least the red ones, are inside of the range that we're focused on. You know, a lot of times they'll be just beyond the range. They'll be outside the low end or outside the high side. And we have to get through yesterday's low or yesterday's high to get to that ADR. Today, we don't. We have to get through the ADRs before we can challenge yesterday's high. Now, when it comes to yesterday's low, yeah, it's outside of that, but it's still inside of Wednesday's range. That makes it easier to break through yesterday's low and less easy to break through yesterday's high. Central pivot range. The top of the channel is basically the half back of yesterday. It's the area that we've been fighting. The channel today, higher than the channel of yesterday, completely outside the zone, which is a bullish bias, but price opened underneath that channel, and that's a bearish bias. That's why the channel is red this morning. It's not as wide as this channel from a few days ago, but it is wider than we would want. A narrow channel implies that if we break out, the breakout could grow legs and really run. A wider channel implies that if we break out, it likely fails and we come back in again. Now, these channels don't make price do anything. So they're just giving us an idea of what to expect if we do attempt a breakout. At this point, we don't expect a breakout to stick. Spot Gamma has something called the Gamma Index that goes from a -4 to a +4. And if it's above 0, the chances of a breakout growing legs and continuing to run goes down, the higher the positive number is. If it's a negative number, the chances of a breakout growing legs and running increases, the more negative the number is. So it's very similar to our use of these channels. It's more than one tool designed to try to answer that question. What if we break out today? Do we buy into strength or sell into strength, right? Do we sell into weakness or buy into weakness? We don't have the AM edition founders note yet, so we don't know what the day's gamma level is yet, but it's worth a read when we get the AM notes. The one from the PM last night, it was at 2.2, which is a positive number, which implies if we break out, the breakout fails and we come back in again. Just to be clear, it was a positive number yesterday too, and we opened with a breakout. We were way up here when we had closed way down here. And we got back inside that range by the end of the day. Why? Because the breakout failed. $58.88 is where this week's point of control is. We've already crossed through it multiple times. It's not acting as a support or resistance level. You should view it more as a perspective of bias. If we're above it, we need to maintain that bullish posture, that bullish bias. And if we're below it, we should, consider a bearish posture and a bearish bias. A little bit of a speed bump around 58.65. And if we break through the liquidity zone at 58.50, we do have a point of control at 58.32 cog line. It's amazing how those cog lines just keep coming back into play again and again and again. I think that's about the ugliest 10-day, 30-minute volume profile I've seen in a long time. Talk about falling out of the top of the tree and hitting every branch on the way down. A lot of speed bumps here. And I think it really kind of highlights the algo stepping stones, right? Where we change lanes, build up structure, change lanes, build up structure, change lanes, build up structure. The point of control on the volume profile doesn't match the point of control on the TPO profile, and we're expecting that to change. It's very likely 58.32 cog line is going to become the new point of control soon. But it's worth noting that even with all of this structure down here, that's Friday, Monday, Tuesday, and part of Wednesday, all of that is outmatched by a little bit of price on Monday, a little bit of price on Tuesday, Wednesday, Thursday, right? Got a lot of volume up here without a lot of contact up here. So let's see if we get that shift. We'll be looking for the point of control to move down to match this level. If not, we'll be looking for this one to move up and match that level. We also have a disagreement this morning between the volume profile and the TPO for the intraday. We had a reasonably decent session. You know, if we were to turn on the session profile, you'd have like the Asian session and then the London session. And we can see right now that all of the most trades that took place, 58.86, it's the blue one over here. It matches up with the Asian session, all of that liquidity. But we had the greatest amount of volume up here in the London session. And we need to keep this. It's very likely that if we get underneath this level today, that we won't be able to get back through it today. So right now it's not acting as a support or resistance because we're coming back and forth through this zone. Once we expand away from that zone to the downside and we try to come back up, it will very likely act as resistance. If we expand beyond it to the upside and we come back to it, it will very likely act as support. But until we get away from it, it's not going to be supportive. It's going to continue to act like a magnet. We are 3.14% above the 10-week. And if I put my mouse there, you can see we've been higher than this before. You don't really want to use phrases like overbought. So it just gives you some bad assumptions about what the market should do. We're extended, sure, but we're not too extended. We could consider that the market is getting to a point where it may want to pause and consolidate and digest the moves that we've had over these last 5 weeks. Absolutely. We can call that a correction, but a correction doesn't have to happen in price. It can happen in time too. So if we just hold the line and don't fall back down, the 10-week will come to us. We really don't want to think of being too extended until we get above 4. We're not even at 3.5 yet. I put my mouse at where 4 is. You can see, sure, we've been higher than 4 before, but we rarely keep it, right? We get up there and we start heading right back down again. So this is not overbought. It's not overextended. It hasn't moved too far, too fast yet. It doesn't owe us a pullback. Now take that and put it on the daily, and we're only at 0.72%. So we're not even 1% away from the 10-day moving average, which again implies we're not overbought. We're not overextended. It doesn't owe us any pullback. And that makes sense because we're sitting inside of Monday's candle. We have done nothing all week. Nada. The week's range gives us the high side at 59.56 and the low side of 57.50. That's how far we could have moved this week and still have been considered just a normal week. We want to compare that with the projections for next week. Now, keep in mind, next week's lines are not set yet. They're still moving. As the ES moves up and down throughout the day today, next week's levels are also moving up and down. At 4:15 tonight, they'll lock into place just like all of these old lines back here. And once they're locked, they won't move anymore. We can measure the week that we have now and compare it with the projection for next week. And we're really just trying to gauge, what does the volatility look like next week? Because these levels, this range that we're looking at, is built based on the measurement on volatility. If the volatility is low next week, the range will be smaller than the range we have this week. Next week's range looks really close to the range that we have now. So really not too much of a surprise there. No red flag warnings either. If it was really small, we would need to be concerned, go looking around, because as weird as it sounds, big events suppress volatility. FOMC, Jackson Hole, NVIDIA earnings, CPI, non-farm payrolls. Those big events suppress market moves while we wait for the event to get here. And that suppresses volatility until we actually get the report, right? And then we get the big move and everything gets all wild. So if next week's range was really small, we would be concerned and want to go find, why is the market so worried? If it's bigger or if it's equal, then it's kind of the same old, same old. So at this point, it's just a hint of what we're getting for next week. We don't know if this is what it's going to look like at the end of the day, and we will look at it again on Monday. So we'll see it when we get there. With the way things are today, we really want to be looking at the idea of a highly correlated market structure. Because we've got some good things happening this morning, and it's not coming through to the S&P like we would expect, right? One, that move in the China group, that's got to be like a dead cat bounce. We were down more than 16% in a 5-day period. And after falling 16% in 5 days, it's bouncing to the upside. And what a bounce. I mean, it's up 6% this morning, but it's still just a bounce at this point, right? We're going to bounce, rally into resistance, roll over, and keep going to the downside. Dead cat bounce. Then we've got the semiconductor move, the Mag 7 group. So the FANGs, they were down, like 4% in a 5-day period. Now they're up 2% this morning. Bitcoin is up, semis are up, Mag 7 are up. That's a really good collection to have for a rally day. Those are exactly the things you want for a rally day. So why is the S&P not even up, 0.75%? Therein lies the rub, right? And what's the hedging about? So we really got to watch that hedging to see if it's going to continue to expand. Make sure at 8:30, after we get the econ that we think is causing this hedging, see if it starts to decrease afterwards, because we're assuming this hedging is because of the housing permits and the report that we're going to get, right? But what if it's not? What if it's something else? It wouldn't be the first time that the markets were hedging against something that wasn't an economic calendared event. So we have to roll with the assumption that we have, but after 8:30, it should begin to decline. That market maker move level should start to go down. And if it doesn't, then we were wrong. it wasn't that event, and we want to continue to hunt to find what is the event, what's causing the need for the market maker move. So tech, semiconductors, precious metals, Bitcoin, and China group. Solar is basically flat this morning. It maybe wouldn't hurt to look at something like IPO too, because we do have a little bit of small caps with the Russell. It kind of feeds in some with things like precious metals and Bitcoin. There's a number of penny stocks that kind of fit into that, small cap companies. If we can add that to the checklist of things that are up this morning and all moving in the same direction, we could get a highly correlated market event. That 95 names, 97 names, all moving in the same direction, all doing the same thing. One scratch that I don't like about all of this morning, and it's the reason that the S&P isn't matching the NASDAQ in its movement, is finance. So keep your eye on finance today. KRE is usually a better tell since it's more localized into specific things like banks. If you just say finance, I mean, that's insurance, it's trading firms, it's banks, it's credit cards, mortgage lending. Finance is just really vague. So if you want to keep your eye on the banks, KRE, it's a good way to go. Getting a little bump in the VIX this morning, but it's still underneath $20. Names in the S&P that are down 0.5% or more very likely tie into why the Dow is also down. We got CVS, right? CVS with a big move down. Procter and Gamble kind of fits into that too. Colgate, Palmolive, those are boring, slow, not big tech names, but they are big names. Names that are up in the S&P 100, 100 at least 0.5%. Semiconductors, lots of semiconductors. And then GM and Ford, which is odd. You know, they had that big battery event in Detroit last week. They really didn't get any love out of that at all. Most people afterwards, when I was talking about it, said, wait, what? There was an event? I didn't know there was an event. What event? Just didn't get anything out of it. They're getting a little bit of a move today. And Apple does fit in a semiconductor space. Remember, they make their own chips, right? So they are a chip maker, even if it is for themselves. And then Caterpillar continues to be on this list every day, day after day after day. We continue to see Caterpillar. For the NASDAQ, things that are down at least 0.5%, Gilead and trucking company. Whereas names that are up, 28% of the NASDAQ 100 is up this morning. Semiconductors lead the list, and it's very clear to see. Outside of that, got a lot of packaged software. We saw that last week too, right? There was like 2 different days last week where software names were just getting it. Trade Desk, Datadog, Mongo, Zscaler, just lighten it up. So we do have some pharmaceuticals, some industrial names, but semiconductors are leading the charge. NVIDIA is not even up 1% though, but ARM close to 1.5%. Baidu, which makes chips too, up 4%. So that's a part of the China group. Baba, Baidu, both chip makers, both up this morning with that very large gap. On back up to its halfway point. So sure, chips are up, but not by much. I wouldn't read into that in too much of a negative way. From one point of view, we wouldn't want them up 4-5% in the pre-market, right? For one, that would imply we missed pretty much the whole darn move and we're not going to get anything else. So the fact that they're not up, 3 and 4, 5% this morning, it's not a bad thing. But on the other side of that, where the heck are they? Why aren't we seeing more of it? And why is it not translating into moves in the ES and or the NASDAQ? We're still inside day, right? We're still trying to just recover from where we were yesterday. We're not seeing that translate across like we generally would. We can see the Mag 7 better here. Amazon is flat. Microsoft also flat. Broadcom, okay, 0.25%, but really, I mean, that's not much of nothing. Google's not even up 0.5% yet. So what do we got? Apple, Nvidia, Meta. That's it? Netflix. But Netflix was earnings and it's already gone way too far. Right? So out of the Mag 7 group, we have the potential to really expand. We just need to do the thing. So that's what I would be looking for, is that expansion in the Mag 7 group. This is a ratio chart of the FANGs, the FNGS ETN versus the QQQ ratio. When it's going down, the Qs are outperforming the Mag 7 group and it's going down. So if the Mag 7 is in control today and they're going to carry us to new highs, we would want this pointing up, not down. Watch the news. Keep your eye on that 830 print. Because if they're worried enough to spend money and hedge against it, we need to be worried about it. Otherwise, my base case argument for today is that we're going to hold the line, go into the weekend nice and sleepy, and we don't get out of this box that we have drawn here. It's a pretty good size box. It's 75 points from 58.50 to 59.25. I know it's a really wide box, but the easy thing is if you get through the half back to the upside, you got your long play on, And if you get through the half back to the downside, you got your short play on. So get out of that zone and you can get to the edge of the box. Money to be made, right? Everybody be careful, be safe, have a good weekend. I'll